Good morning, everyone, and thanks for having me here this morning. What a whirlwind of a day, but we're all here and the weather's turned it on, so how exciting. And I can't wait to hear lots of the presentations today. I know some very exciting times in the markets. We just hit a record high yesterday, so talking about the markets yesterday was very easy. But the thing to note about the markets at the moment, they are at a record high, but it's not across the board. There are sectors that are doing it really tough, and there are sectors that are outperforming. So when you're looking at the markets, it is a good time from an overview perspective that we are at a record high, but we are expecting a pullback in the near term. So keep that in mind. So first of all, legal team don't get paid if I don't say this. So just a disclaimer, anything I say today is simply information only. No advice to be taken, but if you do like some of the stocks I talk about, feel free to do your own research and potentially look at investing. I know a few of them are here, so always talk to the CEO or managing director as well. Now, who are we? We're Bell Direct, an online trading platform that is here to make your life as an investor, an Australian investor, much easier, simpler and more informed. My job is to live and breathe the markets every single day and present to you the most up-to-date and informed information to help you make the most informed investment decisions on the market. And as I'm sure you can all agree, it's a very tough time to read markets directionally and what's happening obviously here and around the world. So today I'm here to give you some ideas about what the ground rules are and obviously find some hidden gems in the market as well. So I thought we'd start with a sector chart, looking at how the sectors have gone over the last 10 years. What this says, it's a very messy chart, so stick with me. But what it says is that different geopolitical events, different economic updates, macro outlook, and obviously changes in the markets have different impacts on different sectors. So the first sector there that I look at is healthcare. Now, healthcare is a top one, yellow up there, and I think you might be thinking, why are we talking about healthcare at a mining conference? Just stick with me. The healthcare sector's outperformed over the last 10 years, and that's because all of the companies there have all this serious timeline to commercialisation and profitability, but a lot of money is required in this sector. So from the day I say I have a drug that could treat this disease or disorder, to the day it's commercialised is around 10 years and a lot of money. So we're hitting these valuations that are really, really high at the moment because of companies reaching commercialisation phase. Neuren was the top performing stock on the ASX last year, up over 200%, and that's because they reached commercialisation phase for their drug Daybue. It's the first treatment in the world for Rett syndrome, which is a neurodevelopmental disorder, and naturally investors piled in. But the thing to note about the healthcare sector, it's unlike a lot of other sectors where the sky really is the limit for a lot of these companies once they hit commercialisation phase. Unlike other sectors like discretionary or staples where demand really is determined by fluctuations in the market, fluctuations in interest rates and all these other things. So when you're looking at markets and sectors, you need to look at the impact on the sectors, revenue to runway, revenue to growth and outlook. The one below that is tech. Tech sector is the most volatile sector. I like to call it my roller coaster sector because you don't know what's going to happen. It is the sector that everyone wanted to be in 2020 because when COVID hit, sports stopped. So where were people going to bet their money? On the markets. And tech was fun to be in. And a lot of people didn't understand that how the markets work. They just got told by their friend, oh, you need to buy Afterpay shares. So they did. And then all of a sudden the markets kind of settled down a bit. And we've had more dormant clients than ever across all of the trading platforms because everyone piled into the markets during COVID-19, but now they don't understand the markets and they don't understand the fundamentals. So they're sitting there going, I need to understand the markets, and they're back to their sports betting and things like that. So that's the reason that the tech sector is so volatile, because growth outlook was so affordable when interest rates are at 0.1%, a record low. But then fast forward to 2022 and interest rates started rising, growth outlook became more expensive and investors piled out. Now, as you can see down the bottom there, energy and materials sectors, the materials done pretty well. That's naturally driven by a lot of different economic and macro events. So China's really impacted all of our big iron ore miners around the world. But lucky for our iron ore miners, the price of iron ore has remained pretty resilient, $135 a tonne. But we've got what we're expecting from earnings season, which is actually happening right now, is slowdown in sales because a lot of the iron ore is actually stockpiling on our ports in Australia. And that's because China's weakened economic outlook and growth outlook, because the government there just has not given this material stimulus they've been promising. All of their data keeps coming out saying they are struggling big time. Their property sector is in dire straits. Evergrande went into liquidation this week, one of their biggest property developers. Their population growth has slowed for a second year in a row, so they're declining population. They're actually paying people $2,800 now to have kids. Imagine being paid that to have kids. I don't even think in this day and age that pays for nappies. But anyway, you look at the sector there, retail spend is slowing. Everything is against the odds for China. And that naturally impacts our materials sector. So what you can see as well is energy down the bottom. Energy is the orange one down the bottom. It actually underperforms the market, the rest of the market over a 10-year period. But there are some serious key opportunities in this sector and some key names here today. So how do I read markets? I look at macro factors because it's a macro-driven market right now. As I said, China reopening, that has a massive impact on commodity prices. Lithium has been absolutely turbulent because of China's reopening, EV sales around the world, and China's obviously BYD becoming the biggest EV company in the world, so that's shaking up the market there. The gold price outlook has remained a key commodity, and that kind of, if we went back a year, I wouldn't have talked about gold at this time last year. It kind of snuck up out of nowhere because everyone piled into gold and wanted exposure to gold in their portfolios because of its safe haven nature and the uncertainty around rates. Now, when people are looking for exposure, and gold has always been a safe haven commodity, and that's why in this day and age, people are thinking markets are so volatile, I just need some form of exposure to gold. So a lot of the analysts out there will tell us that gold is the commodity of the moment, and that's what they're expecting to remain in this in 2024. And the price is sitting around 50-year highs. So you can get exposure to gold through an explorer, developer, producer, an ETF, or even physical gold. So there's a number of ways you can get exposure to gold, and that is the commodity all of our analysts are talking about at the moment. Now, cost disinflation, a lot of people say, isn't it cost deflation? No, it's just the reducing amount of inflation of costs for a lot of different companies. So deflation means it's going backwards, disinflation means it's just slowing down. And that's really going to fare really well for a lot of our miners, a lot of our companies in Australia heading into 2024, especially the second half of the year or the financial year, because what we want to see is the companies that didn't increase prices across the board, they've really felt margin contraction. So the ones that have done the right thing, so Goodman Group, James Hardie Industries, they increased their prices. And that was a really strategic move in 2023. Didn't impact demand or sales or anything like that. And it actually saw profits soar. So that's why James Hardie was the third top performing stock on the ASX 200 in 2023. Now we look at interest rates. The Fed did not cut interest rates as everyone was expecting, and markets responded accordingly this morning. Wall Street closed lower overnight. To be honest, I think markets prematurely factored in rate cuts. The Fed have said they will not cut until at least March, with 3 cuts on the horizon this year. I actually think it won't be until June because we know the Feds are so aggressive in their strategy, but they will not let inflation get out of control. So until they see some form of trend and some form of security that inflation is coming down, they're not going to cut. So markets factored in last year. As soon as the Fed said, we've got 3 cuts next year, the markets went on this crazy rally because everyone thought, come January, we got 3 cuts, bang, bang, bang. And that's not what's going to happen. So then markets have readjusted and repositioned back to higher for longer and more safe haven stability. So interest rates in Australia, we're expecting to stay on hold higher for longer until later this year because, again, everything is going in the right direction. We've got CPI coming down, which is great, to the lowest level in 2 years. big tick there, and all of us are feeling it. I know we're all feeling it, so hang in there. But house prices are still soaring, wage price index is still it's still really high, and producer price index as well. So until those ones start to come down in the way that retail sales have, and obviously CPI and GDP is remaining resilient, once all those factors come into alignment, that's when we'll start seeing the RBA start to comment on rate cuts. So come Tuesday, it's expected they will hold, but we are more interested in the outlook for what they're going to say about when cuts are on the horizon. And obviously AI is driving the tech rally out there at the moment. So when you're looking at AI, you need to be really careful about a company that says they're investing in AI versus a company that is actually investing in AI. And I know a lot of our mining companies are actually investing in AI now to enhance operational efficiency and on the safety front as well. So when you're talking to the miners today, maybe ask them as well about if they're even considering AI. So yeah, without further ado, I thought we'd jump into some stocks and sectors. So uranium is the sector, or it's the commodity that everyone is talking about right now. I literally just sat with Siobhan Lancaster and had a chat with her, and what an exciting time to be exposed to uranium. Now, uranium, a lot of countries around the world have started to turn back on nuclear power plants. I think there's about 60 nuclear reactors in the works right now, and nuclear power relies on uranium. Now, the price has come up to $106 a pound. Last year we were talking about this, it was $55 a pound, and everyone was saying, no, it won't hit 100. And I know Siobhan was up against it for the last year, but we've hit $106 a pound because this is the real deal. Uranium has had a few false starts, but it is a really exciting time to be in uranium. Now, Bell Potter has two stocks in their uranium front. I know Boss Energy is often here talking at these events, and I know Boss Energy is one that we like to talk about. Now, Boss is the uranium producer out of South Australia, the Honeymoon Mine. The company actually, the reason that we've got the spec buy rating, it actually got downgraded to a hold just yesterday. That's because of the rally that's been going on in the market. There's nothing wrong with the company, but I thought I'd say that because I know Regan, our analyst, will may be watching this. So he did downgrade it to a hold just because of the rally. But the fundamentals behind the company, Boss Energy, are there. Their Honeymoon Mine is ready to be it's turned back on. I think they're washing through the mill right now, the uranium, so that's ready to go. They also just made a recent acquisition which expands them geographically into Texas. So what that says in the company that you're looking at, having assets all over the world is a really strategic play. And for Boss, their exposure to Texas and through the 30% interest in the Alta Mesa Restart project is a really exciting time with the ramp up to a 1.5 million pounds per annum over 3 years. So with that in mind and with the Honeymoon Mine ready to go, it shows that Boss Energy is at the forefront of a lot of investors' minds. I've been talking about this for this company since I think 2 years ago, Nick will know, and it's a company I didn't actually invest in, and I kick myself every day because I didn't. So a lot of our people at Bell Potter and Bell Direct invested when I said, oh, you guys should get in. And I didn't. So that's one I kick myself every day. And Paladin's the other one that we've got a spec buy on. They're actually operating out of Namibia. Now, they have the Langer Heinrich mine. It's 93% back into, or restart is 93% complete. They're ready to go. It's a proven project. They've produced uranium from there before, so they know what they're doing and they're ready to go to address this undersupply, over-demand problem in the uranium sector. So that's two, and I'll let Siobhan obviously talk about 92 Energy, which is another exciting company on the uranium front. I know I'm talking really fast. I have 1 minute 30 left, so stay with me. The other one that has been on my radar for a little while that I'm really liking the look of is Develop Global. Develop Global is a company that is a hybrid, so it has mining services and it has its own assets. The really exciting thing about this company is that all of its assets operate in the green energy transition. So they cover all the commodities required for the green energy transition. Zinc, copper, lithium, and that's it, I think. Yeah, zinc, copper, zinc, copper, lithium. And so moving forward, they've got their own assets ready to go, and they've got funding coming in from their services division. They've got the $400 million contract at the Bellevue Gold Mine. I actually went into the Bellevue Gold Mine to film an interview with Darren Stralow and saw the Develop Global boys working there. So that was awesome to see exactly how they operate. And I can tell you they're working very hard down there, and that's exactly why they've got the $400 million contract. What they do with that money is they fund it through to the exploration and development of their own assets. And that really is strategic for an investment point of view, because they're not going to come knocking on your door doing a capital raise from your pocket at this exact time, because they've got money coming through to fund the development of their assets. So that's why we like Develop at the moment, and it's the reason that we have the diversification. It really matches diversification for a lot of our investors out there looking for that. And I'm -3 seconds over. So I hope you enjoyed that, and I'll be back walking around later on if you want to have a chat about any of our stocks today.